If you could pick only one account to power your retirement, would you choose a Roth IRA or a 401k? The choice you make today quietly shapes how much tax you pay and how much you keep when you retire. Today, we break down a practical, no-jargon strategy you can apply this year to decide between them and to use both without wasting money. If you're juggling student loans, a family, or a career that might boost your income, this framework keeps you flexible and ready for changes. A Roth IRA is funded with after-tax money, and in retirement, the principal and growth can be withdrawn tax-free if you meet the age and holding rules. A traditional 401k is funded with pre-tax money, which lowers your current tax bill. When you withdraw in retirement, you pay taxes on those withdrawals. Think of taxes as a bet on future you that you place every time you contribute. If you expect to be in a higher tax bracket in retirement, Roth often wins. If you expect lower taxes later, traditional can be smarter. This isn't a crystal ball, but it tilts odds in your favor over decades. The employer match in a 401k is basically free money. If your employer offers even 50% up to a percentage of your salary, contribute enough to capture the full match each year. The real cost is fees and investment choices, which can quietly eat into returns over decades. Step 1 is simple. Secure the match first by contributing enough to get the full employer match. Treat that as your minimum goal before you move money elsewhere. Step 2 is the Roth decision. If you can contribute to a Roth IRA after securing the match, do it because withdrawals in retirement are tax-free. If your income blocks direct contributions, you can use a backdoor Roth by contributing to a traditional IRA and then converting to a Roth, but watch the tax on any pre-tax money. This path adds tax flexibility later, which helps if tax laws change. Step 3 is to use the 401k for more savings after the Roth is filled. Contribute up to the plan's limit if you can, especially if your budget allows for it without sacrificing essential expenses. While you do this, choose low-cost index funds and avoid high-fee specialty funds that eat away returns. Beyond the accounts, think about diversification. Keep some money in taxable accounts when it fits your timeline and tax situation so you have flexibility in retirement. A simple rule is to plan withdrawals so you minimize taxes and stay within affordable spending. Review this plan every year. If your job changes, your income changes, or tax rules shift, adjust how you split between Roth and traditional. Small tweaks now prevent big tax surprises later. A practical example helps. A 30-something saver with a modest salary starts with the 401k match, then adds a Roth IRA, and finally fills the 401k with index funds. In 10 or 20 years, the mix of tax bands and withdrawals can look very different, which is why balancing now matters. The point is not perfection, but consistency. If you found this useful, hit the like button and subscribe for more practical money habits. Tell me in the comments what mix you're aiming for this year, and I'll respond.